Talk about stablecoins because this is a type of digital or cryptocurrency whose value is pegged to an asset. Most often it's pegged to the US dollar. Now, so unlike Bitcoin, for example, or Ethereum, whose prices can swing wildly, stablecoins are backed by reserves such as cash or US short-term treasuries or T-bills to keep their value fixed. The market for stablecoins has exploded as of 2025, like you just said. Some estimates put that at $300 billion. Citi, for example, predicts that a figure could top $1.5 trillion by 2030 or $3.5 trillion in a bull case scenario. So what are they used for exactly? Well, inside the crypto markets, traders use stablecoins to move between volatile assets without cashing out to the bank. They operate 24/7 and settle quickly. They're also used for cross-border payments, digital commerce, trade, and they have the potential to generate yields when they are lent out on exchanges or decentralized finance platforms. And in countries with unstable currencies or where they just don't have easy access to US dollars, they have been a convenient option. A handful of companies dominate the space. The largest by far is Tether, a private company known for its coin USDT. Circle, which went public in June, you'll recall, issues a stablecoin known as USDC. Together, they control more than 80% of the global stablecoin market. The majority of the money that's backing those coins are parked in US Treasury bills. And that is a big reason why the US government is encouraging the use of stablecoins and passed landmark legislation over the summer, creating guardrails for the industry itself. Issuers have become major buyers of short-term government debt, effectively creating new demand for treasuries and extending the reach of the US dollar worldwide. So in short, stablecoins are becoming the bridge between crypto and the dollar and becoming a key component of digital finance. Digital asset treasury companies. So what are they and what do they do? This is what they are. A digital asset treasury, basically called a DAT, is a business that holds a large amount of digital assets like Bitcoin, like Ethereum, on its balance sheet. And unlike traditional firms that hold cash or bonds, DATs raise capital through stock or debt, and then they deploy it to buy cryptocurrencies. Their valuations often move in tandem with the value of those tokens. So here's how they operate. First, they raise the money and then they purchase the digital assets, often Bitcoin, sometimes it's Ethereum, and use specialized custody security systems to manage them. And then they lend them, they can also lend those tokens out or stake them to generate extra yield. Their stocks trade at premiums or discounts based on the value of those holdings and investor sentiment. So who are the biggest players? Well, the giant in the space is Strategy, formerly known as MicroStrategy, led by Michael Saylor, the world's largest public company that's holding Bitcoin, the largest holding of Bitcoin. Other companies include Bitmine. You also have Mara Holdings, Metaplanet, SharpLink Gaming. These are some of the companies that have adopted crypto-heavy balance sheets. So in total, public companies now hold more than 1 million Bitcoin, roughly about 5% of the entire supply. So why the surge in interest? Well, first, you have institutional adoption that's accelerating from pension funds to hedge funds. More capital is entering the digital asset space. Also, you have regulatory clarity that's improving. That's making it easier for companies to hold and report digital assets. And many executives see Bitcoin as a hedge against inflation or just a more productive use of treasury cash. And finally, the market sees these companies as high beta ways to get crypto exposure without directly buying the token.